This is the second video on adjusting entries. Here we're going to talk about accrued expenses and revenues. Um, in the first video, we talked about deferred expenses and revenues, and in that situation, we paid or we had received the cash first, and then we recognize the revenue or expense. In this situation, when we're talking about accrued, we're going to go ahead and recognize the revenue or expense, and we're going to pay or receive the cash later. So here we're going to recognize the revenue or expense first, and the payment of or receipt of cash is going to come later. The deferred, we'd already paid or received the cash, and then the adjusting entry was to recognize the revenue or expense. And remember, that's always the case. We are recording our adjusting entry to recognize the revenue or expense. So our accrued expenses are where we have an expense that we owe or we've incurred that we're going to pay later. And so we're going to go ahead and do the adjusted entry to record that expense that we owe or we incurred. So our first example is our salary expense. Our salary expense, we're going to do an adjusting entry to record the expense. And then we're going to also show a liability, because remember, we're not going to pay it till later. We're not going to pay it now because we're going to pay it later. Okay, let's look at a quick study. (313). We're going to look at quick study 313. They have an employer who employs one college student, and they work 5 days a week. They work Monday through Friday, and they are paid $100 a day. And so they want to do an adjusting entry on July 31st, because that happens to be on a Thursday, because they say August the 1st is on a Friday. So it's the end of the period. So we need to do an adjusting entry to, and they don't pay till Monday. So we need to do adjusting entry where we're going to go ahead and recognize the salaries expense for Monday through Thursday through the end of the month. But we're not going to pay it till later, so we're going to credit salaries payable and create a liability. So if Monday through Thursday, I'm going to use the R for Thursday, is in July, that's 4 days, and it's $100 a day, you would do that for $400, because August the 1st is on a Friday, so we can't record Fridays yet in July. And so that would be our adjusting entry, where we're going to recognize the expense and we're going to pay it later. So kind of to review that future pay, remember, this is the adjusting entry that we made. And I just kind of want to go over the future payment. So August the 1st is Friday. They're going to pay on Monday. So the payment is going to happen on Monday, which happens to be August the 4th. So on August the 4th, we're going to do an entry. First of all, we want to make sure we record the entry. We're going to get rid of the liability. So we're going to debit salaries payable for the $400 that comes from that one. And then we need to record Friday, August the 1st. So we need to record a salary expense for 1 day for Friday. And then we're going to credit cash for the full amount, so we pay the full $500. So that would be the subsequent payment. This accrued expense also occurs a lot of time with interest, where we're going to do an adjusting entry in order to record the amount of interest that we've earned that we may not receive until later. And so we go ahead, that we've incurred. I apologize for that. So we want to record the amount of interest that we've incurred, not earned. And so what we want to do is we want to debit interest expense to show the expense, and the fact that we're not going to pay it till later, we want to go ahead and create that liability and credit interest payable. And so we want to look at quick study 312. Quick study 312, and we want to look at B. Let's do C. Let's look at C. C says, as of December 31st, the company holds a mortgage payable that has incurred $875 of annual interest that is neither recorded nor paid. The company intends to pay the interest on January the 7th. So we're going to go ahead and on December 31st, remember, our end of the period, we will record this interest expense by debiting interest expense and crediting interest payable. And then that they said that future payment, remember they said that they would make this payment on January the 7th. So when we make the payment on January the 7th, the first thing we're going to do is what? Receive cash. I keep wanting to make this a revenue. I apologize. The first thing we're going to do is say we're going to now pay this payable that is due. So we're going to debit the payable, and then we're going to credit cash. We're going to credit cash. So that's what we would do. Remember, the adjusting entry is the recognizing of the interest expense at the end of the year, and then the future payment is just kind of to show you what the entry would be when we made the payment. And then our last entry we want to look at is accrued revenues. These are revenues that are earned, but they are not yet received. And so we're going to actually receive them later. And so one example, of course, has to do with service revenue or revenue. So it's going to be a situation where we're going to do an adjusting entry to recognize the revenue now, because we've earned it. You recognize the revenue when you've earned it. Okay? And so let's just look at quick study 314, and we want to look at A. And so 314A says that at the year end, Accrued company has completed services of $19,000 for a client, but the client has not yet been billed for those services. So we completed the services. So remember back in chapter 2, I believe, we record revenue when it's earned. And so we would go ahead and record the revenue, because I'm not going to receive it till later. I'm going to debit accounts receivable for that $19,000, and I'm going to go ahead and record, and let's just call it service revenue, the revenue now. And so that would be the entry. And so later in the future, when we bill them and then they actually pay us, we're going to debit cash for that $19,000, and then we're going to credit accounts receivable. It's important not to try to record the revenue again, because you already did it. You record the revenue when you earned it. And so therefore, when you receive it, you want to get rid of the accounts receivable, so you credit it. Remember, this is the adjusting entry. This is just the future receipt entry. And the last, which one I kept confusing, when I was talking about interest expense, I kept referring to interest revenue. And interest revenue is a situation where we've earned the revenue of interest, but we won't receive it till later. And so we want to look at quick study 314. And we want to look at B, deals with interest. And so it says that at year end, the company has earned but not yet recorded $390 of interest earned from its investments in government bonds. And so remember, I'm not going to receive it till later, so I got to debit interest receivable for the $390, and I'm going to credit interest revenue. So I go ahead and recognize the revenue now, and that's my adjusted entry. And then remember, the future payment is going to be a debit to cash and a credit to interest receivable. That's it. I hope this is helpful. Make sure you let me know if you have any questions. Practice, practice, practice.